What is going on, guys? Nick here, back with another video. So over the past couple of days, Jeremy from Financial Education and Paul from Everything Money have been kind of having at it in some pretty aggressive videos going after each other. This all started with Voyager, which is a company that Jeremy had promoted on his channel. Probably got paid to do it. I don't necessarily know. This company went bankrupt, and he had been suggesting to other people that they should be purchasing this. And Paul from Everything Money basically challenged Jeremy, saying that
I'm going to do a 10-year challenge. $1 million. $1 million, Jeremy. The winner gets $1 million to the charity of their choice. You decide if you're in or not.
He said that he couldn't become a value investor all of a sudden, that he had to stick to promoting a whole bunch of other companies that he's already been talking about.
Now, are we going to have to negotiate a few other things? Yeah. You have to invest in your style. You can't suddenly become a value investor. I want you to invest in your hype BS stocks. And guess what? I will not invest in hype stocks that are selling at nosebleed valuations. I'll stick to my boring ass loser value plays.
Jeremy, on the other hand, has kind of fired back at Paul, saying that he's not transparent. He doesn't actually show what's in his portfolio on camera, which is true. It's all kind of hidden, and I guess this has to do with some kind of legal thing where, because Everything Money sells a lot of their services through a paywall, they don't necessarily want to put out all of their great purchases, for the internet to see. I think that's a little bit crappy, but
I'm not hiding any losses. Do I have stocks that are down? Absolutely. I'm not hiding anything, guys. The only thing I do not discuss is things our lawyers, because we have this community that we charge on software, says, listen, you cannot do certain things.
Nobody asked for my opinion, but I'm going to give it anyway. When it comes to Jeremy and a lot of his videos, there's just been a lot of just random crap that don't really seem to be great companies to purchase and hold long term. And I guess this has to do with a lot bigger audience looking to find those deep hidden gem, purchases, the stocks that are going to increase by 1,000% over the next 10 years. So he's kind of migrated some of his content doing that. Now, on the other hand, Everything Money is the complete opposite of that. A lot of their content, it seems, in my opinion, to be way too conservative, where they're basically saying everything's so overpriced and everything's so overvalued. And Paul, to his credit, he says he has made money this year. Unfortunately, we've never seen that on camera, so we don't necessarily know that. I'll take him at his word for it. I don't think that he's making this up. However, there is a video from him, I believe last year or the year before that, where he said over the past 5 years he hadn't made any money in the stock market. So
I have not made any money in the last 5 years. Do I blame anything? No. The market just went even more irrational.
That's great that you're up in a bear market when you've been like an ultra conservative investor. If you invested all your money 5 years ago, even with the downturn that we've seen, you'd still be up pretty significantly. So if you didn't make money over the past 5 years, that's not real great in my opinion. I think that sometimes he's just way too conservative with some of his picks, and he's too fixated on the trailing fundamentals rather than looking forward a little bit, which sometimes can get you into trouble. But if you are reasonable with it and you're not looking at in the next 10 years this company's going to do whatever, and you're looking at what the company's going to do over the next year or two, you're seeing consistent solid profit, you're seeing a healthy balance sheet. These are the companies that you should be buying, and you're missing out on a lot of really good opportunities by only looking at trailing financials that end up getting you companies like Intel and Alibaba. So I wasn't challenged specifically, although if one of them wants to challenge me and also give me $1 million, because I don't have $1 million, I would gladly take them up on that. So the rules from Paul on Everything Money were...
But here's what we're going to do. Whoever's winning after 1 year gets 50 G's. 3 years, 100 G's. 5 years, 200 G's. This honors everything you do. 10 years, $650,000. Here are the rules. We put it in some sort of big brokerage, E-Trade, Charles Schwab, Fidelity. They get on board, and I'm sure they will, that at the end of every year, they announce the returns. That's it. You have to pay the taxes out of your own pocket. No money coming out of the account, no money going into the account.
So if I was challenged, and also if I was not allowed to touch or do anything with any of these stocks over the next 10 years, here are the 10 companies that I would purchase and enter into this challenge. So the first company is going to be Apple, obviously. So over the next couple of years, inflation is going to be a problem for a lot of different businesses. What you really need to focus on over the next couple of years, how able is a company to raise their prices, basically to get past inflation, cover their rising costs of producing and selling their products without losing a whole bunch of purchases. Well, I think Apple is in a fantastic position for this. So First off, the iPhone is obviously their biggest product, and people who purchase iPhones, they don't necessarily see the price of iPhones go up and go, you know what, I think I'm gonna get an Android. No, they go get that iPhone. It doesn't matter if they're sold out, if they have to wait a couple months. And there was a news article actually from just a few months ago that said 87% of teenagers have iPhones. This is a very sticky product. You know, you're going to own it. You're going to use it for a very long time. It's going to become a very important part of your everyday life, is how well your phone functions and how much you like your phone. If Apple has to raise their prices by 10-20% to deal with inflation, I think they absolutely have the ability to do so. On top of that, they've continued to grow out services, and this is actually starting to produce a pretty substantial amount of profit for them. They've gotten away from being so reliant on iPhone sales and the iPhone supercycle to kind of keep their business rising and going forward, and this services segment is a huge boost for their growth going forward. Financially, this company is an absolute powerhouse. Actually, over the last year, they brought in $102 billion in profit. That is an insane amount of money for one single company to be bringing in, and while some of that is going to go out as a dividend payment, there's a good chunk of that that's going to be used to repurchase stock. And if you own stock, this is basically a hidden dividend or a hidden growth multiplier. I think over the next 10 years, Apple has a very, very strong likelihood of being just as capable in 2032 as they are in 2022. Okay, so the next company on this list is another big one. It's Amazon. So Amazon over the past year and a half has actually had it pretty rough. If we look at the split adjusted price, it looks like they were trading at about 185 at their peak during the surge last year, and now they're down to just 116. Amazon has not had it quite as easy when it's come to inflation, and it's actually really hurt the retail business. The retail business is actually down pretty substantially, and this has hurt Amazon's total profit, especially over the last year. You also have, as the pandemic comes to a close, people are more likely to go out and actually purchase products in person rather than just buying them online, having them shipped to their house. So that certainly has led to a little bit of a growth slowdown. But I think what is really being overlooked here is AWS. AWS is the real profit driver of Amazon. AWS is growing at a much faster rate than retail is. So while retail produces most of the revenue, the profits are driven by AWS, and in my opinion, this is what's going to keep their value rising going forward. Now, AWS as a product is actually a really sticky product itself. Companies send in humongous amounts of information, so much information that it can't actually be sent through the internet. They had to create these data center trucks that roll out to your company, they download it off your servers, and then they bring it over to Amazon servers to upload. This is extremely expensive for somebody to go take their information off of AWS and transfer it to another major service. It's also a huge benefit for a lot of companies to just have AWS service. They don't have to maintain their own servers. When they need more server space, they can easily expand that and scale up. So I do expect, though, that the retail segment is going to come back. I don't see its profits being down forever. People are still purchasing things off Amazon. I see the trucks drive by my house every single day. Long term, I expect that AWS, especially over the next 10 years, is going to continue to be the real profit driver of this company. And I see Amazon still as extremely dominant in this space. So I don't see this stock going anywhere anytime soon, and I actually see a lot of upside for it at today's current share price. Now, the third company on this list is probably not that shocking for absolute lock 10-year stock purchases, but again, we are looking for the most solid, high-growth, long-term buy companies for this challenge, companies that I think have a very high probability of, one, being around in the next 10 years, and two, being able to outgrow the S&P 500. And it also is just a quick side note, one of the issues that I have really noticed a lot with YouTube finance in general is that people seem to think that because you found some great company that nobody's ever heard of with a couple of random letters kind of thrown together, somehow this is a much better purchase than buying companies and brands that you actually know. But buying random crap is not how you should be investing. You should be buying companies with the best and the strongest financials out there. You can buy stock in any company. Why not buy the best? So the third company on this list is Google. Now, I bought my first share of Google in 2017 when Google was making about $32 billion in profit. The stock was trading for $921, and over the past year, Google's profits have risen to $75 billion. Now, the share price, on the other hand, has risen to 2,300. So I've more than doubled my initial purchase, and over the same time span, Google has done a little bit better than doubling their profits. In my opinion, this is how to invest. Find companies that are going to grow their profits over time, especially at a high rate, companies that are actually turning a profit, by the way, not companies who should turn a profit in the future, should. In my opinion, that's how you find stocks that will outperform long term, especially over 10 years. That is a long time to invest. And Google itself, as an ad business, is an absolute dominant powerhouse, and it will be going forward. You know, things might get tough for them over the next year or two if we do start to see that economic recession that the Fed says is a possibility, which means it's probably happening. You might see some companies start to pull back on some of their ad spend. And if that happens, I think that's okay, because Google is still very well positioned to handle a little bit of a drop in revenue or a drop in profits if that actually does happen to their business. On the other side of this, they're still going to be the #1 advertisement platform on the internet. There just is no substitute for what Google can do as an advertising business with all of their wide reach and the amount of impressions and information on the actual people who are visiting these certain websites. So Google as a business is still going to continue to be a rocket ship going forward. I absolutely love the online advertising business as an investment opportunity. And while this company seems like I'm at least hopeful that they haven't lost their focus on what they actually do best, I think this company right now is the absolute cheapest of all of the FANG stocks, and in my opinion, one of the absolute best buys on the stock market right now. And you can probably guess where I'm going with this, but it is Meta. Now, I know, again, I've stuck to some very boring and obvious picks, but again, we're looking at 10 years, and we're looking for conviction buys over the next 10 years. These are the best companies on the face of the planet right now. And while you might be able to find some random company that nobody's ever heard of that's going to 10x itself over the next 5-10 years, I prefer to work a little bit smarter than harder and just pick really good companies with really strong financials that are growing at really high rates. And I think Meta is trading at an extreme discount right now. Facebook and Instagram are still two of the most visited websites on the planet, and their ability to advertise with such precision with all of the user data that they've collected over a very long period of time, especially for small businesses and local businesses, is extremely beneficial. If you go and you spend some time doing some research for small businesses and what, online gurus are basically saying how they should be advertising, a lot of them mention Facebook ads as a fantastic return on investment. And to be honest, out of all the ads that I click on the internet, I most commonly click on Facebook ads. They tend to be the most relevant ads to me. I see lately I've been looking for new button-down short-sleeve t-shirts for the summertime. All of my Facebook ads at this point are just button-down t-shirts, and it gives me all kinds of options. It's just an online shopping mall where I'm just looking at stories from my friends, seeing new button-down t-shirts, more stories from my friends, and to be honest, I kind of like the ads that I get from Facebook. I know that's probably an unpopular opinion, but I just find that there are some great recommendations that they made, and honestly, I bought some really good products from them. For a lot of small businesses, Facebook ads are an absolute bloodline to the marketing world to get their products in front of locals who are actually likely to purchase their products. And while there's all of this Meta nonsense that I don't really believe in personally myself very much, I do think that Meta right now is priced so cheap that basically they would just have to not grow at all going forward for the current price to make any sense, and I just don't see that as very likely. Okay, now the third on this list, if you are somebody like me, Berkshire Hathaway Class B shares, but if you're somebody like these rich guys apparently from Everything Money and Jeremy, maybe the Class A shares. Although I have actually been buying Class A shares because on Robinhood you can get fractional shares, so I just buy Class A because why not? I can. Now, a lot of people out there on the stock market try to copy what Warren Buffett does all the time. They listen to all of his financial advice, how to deal with recessions, how to deal with inflation, but why spend your time trying to figure out what moves he's going to make, what would Warren Buffett do, when you can just buy Berkshire Hathaway and have your own Warren Buffett ETF itself. Now, I know with a 10-year challenge and you're buying stock with a company basically because a 91-year-old and an 89-year-old are running the company might not seem like a great idea because that basically means when this challenge ends, they're going to be either 100 or not 100, if you know what I mean. But this isn't news to Berkshire. They've had succession plans long in the works. They've talked about them at annual shareholder meetings for a long time. Greg Abel and Ajit Jain, I think, are going to be very capable of running this company going forward. I don't see any real severe deviation from what they've already been doing already, and the company is already positioned with a lot of great companies in their portfolio, so I think this company is going to continue to run very well. So again, if you like Warren Buffett and you like all of his investment advice, why not let Warren pick your stocks for you, and also pick two guys to continue to run this company beyond when Warren and Charlie are able to continue running it themselves. All right, so the next one on this list is finally not a FANG stock. And yeah, I know that I've been hammering the FANG stocks and the large cap companies, but again, these are the companies with the strongest financials, and if we're looking at the next 10 years, it's these companies and their moats that are most likely to succeed, so this is why I tend to pick these types of companies to invest in. The next company on this list is Ford. I really like what Ford is doing, and especially as the stock price has fallen, I think that Ford is a fantastic buy, especially at what, $11 or $12 a share that it's trading at right now. I think the new CEO, Jim Farley, has a very clear and strong vision for the company going forward with new and revamped product lines. He seemed to really turn into the whole EV trend, and I think they're going to position themselves to be in great shape as EVs continue to take over. Look, Tesla might obviously be number one in the EV space, but there's a lot of people who just will never purchase a Tesla. I know, it's going to make people sad to hear that. But think about it. The majority of Tesla buyers are people who are young, who are pretty comfortable with technology, and tend to be kind of on the leading edge of new trends, especially when it comes to technology. But for maybe my parents' generation, maybe some other people who, just don't really live on the internet that much, Tesla's probably not going to appeal to them as a product as much. So companies like Ford, Toyota, eventually when they get over to it, there is absolutely going to be a pretty good amount of market share for them to take over with EVs. But I think Ford is doing a great job positioning themselves for the transfer. I really like what I see out of the F-150. I think it's a really smart design. There's a lot of really cool features, like you can power your house with it if the power goes out, which might be a little scary if you have to go anywhere. I really like the revamped Ford Bronco. I've started to see those on the road when I go out and drive around. Now, I am a little bit concerned with their self-driving technology, mostly because I actually saw I think it was a Ford Fusion driving around by myself, and it was not navigating the streets very well, although that could have been the very old man who appeared to be behind the wheel, so I don't know if it was him doing a bad job controlling the car, or if it was just the Ford doing a really bad job navigating itself. This was, I think, 2 years ago that I saw it, so that does concern me just a little bit, a little anecdotal evidence, so don't necessarily take that to heart, but I do really like the product line, and to be honest, Ford at this point reminds me a lot of what Microsoft looked like when Satya Nadella had taken over, right? It had been this old dinosaur company that, it saw its peak basically during the 2000s tech bubble, and then it burst, and then the stock sat flat for the past, 10 years or so. But Satya Nadella came in, revamped the product, changed a lot of how their business actually operates, and I think he did a lot of smart moves to the company that really caused Microsoft to kind of take off and start growing their profits again, which obviously has led to the stock price increase that you've seen over the past, 7 or 8 years. Ford as a company has been declining in stock price for a long time, and its brand had gotten really stale and old. I think Jim Farley is the right type of guy to refocus this company and kind of position them going forward to be in a way better spot, especially when we're in this transition period between internal combustion engines and EVs. So for the next 10 years, it's going to be very important for them to be well positioned in this area. Okay, so the next one on this list is actually going to be a twofer. I could have done these separately, but honestly, I feel like these two companies are just so similar that there's not really a need to do them separately. These two companies have, I would say, the best pricing power of any company out on the market. It's going to be MasterCard and Visa. Now, the reason why I picked these companies is even with inflation and even maybe a decrease in consumer demand, people still really like using their credit cards. There's great benefits to using them, right? You get 1%, 2%, 3% cash back. You get travel rewards. You get in-store purchases. I know I use mine for Amazon. I get something crazy like 5% cash back every time I make an Amazon purchase with it. But the big advantage to these companies companies is the consumer of their products is really the merchants who are pretty much forced at this point to have MasterCard and Visa terminals in their store. Otherwise, people just don't want to show up to a cash-only business. You lose a lot of, potential purchases, so they just have to have that option. But it's not the merchant that makes the decision on whether or not Visa and MasterCards are going to be used. It's actually just the card owner, which means that businesses are basically held captive to using these services because the users of these cards who get all of the benefits and don't necessarily see any of the downsides, which is, 2 to 3% that the merchant probably has to add on to offset some of the costs. They don't see any of that downside. It's easier to use a card. You don't have to carry cash. You don't have annoying change in your pockets. I know I hate carrying around change. I really just haven't carried around cash in years. I only use my credit cards for purchases because I want those points. I want those rewards. And it's just so convenient that I don't see people making a decision to switch away from these. Some people thought that, crypto was going to take over. I think we can at least put that to bed for at least the next couple of years, that's probably not that likely since it hasn't necessarily been the great inflation hedge that a lot of these people would aggressively shout at you if you told them otherwise. Visa and MasterCard are here to stay, and especially over the next 10 years, I think these companies are in great shape and very well positioned to continue to do extremely well going forward. All right, so this next one, I can't leave him out. I've already mentioned his name, Satya Nadella, but what this guy has done for Microsoft with positioning themselves going forward, one of the most impressive business stories that I think that I've seen over the last decade. Microsoft has retained their position as the enterprise software company with Microsoft Office Suite and all of those tools that come along with it, fighting off competition from even free options like Google Docs. Microsoft Office is still the most powerful set of enterprise software tools that any company could purchase, and it's still the dominant player for most large companies. On top of that, growing out the Azure business, just like I talked about with AWS, this is the company that makes me the most nervous about Amazon. It's because their Azure business is so powerful, but if we just own both, we shouldn't have to worry about that too much. Either way, Microsoft is still an obvious buy over the next 10 years. They really have one of the strongest moats of any company on the market right now, so I would absolutely throw them in for my 10-year challenge. And I'll say it again, to beat the stock market long term, you don't have to go digging deep for these hidden gem companies that nobody's ever heard of. We're looking for companies that are going to grow and they're going to survive and they're going to thrive over the next 10 years. And again, Microsoft absolutely fits this bill. Okay, so the last one on this list is actually a company that I got out of recently, but I would like to get back into. It is JPMorgan Chase. Now, I know to a lot of people, their eyes are rolling. Oh God, it's all FANG and banks. Yeah, I know. Banks seem like really boring purchases and they're not going to double or triple their stock price, in a month or 2 months. What I hope a lot of people have been able to see over the past 6 months basically is that with a lot of these highly speculative, highly volatile stocks where they're going up really fast, sometimes you can also get that downside where, the range of outcomes with these companies that don't turn profits are so wide, it's really hard to narrow them down to an actual specific value. But with companies like JPMorgan Chase, one of the widely considered best banks in the industry, you don't quite have the same volatility and you actually have a lot more growth in this company than I think a lot of people actually expect. When you look at their earnings per share, and I know a lot of people like to talk about, price to book value as the main driver of banking value, but I don't know that that's necessarily the case with JP Morgan. When we look at what the company was earning in 2010, we'll say after the recovery of the 2008 recession, they were earning about $3.96 per share, and over the past year, that's grown to $13.49 per share. Don't tell me that bank stocks aren't high growth stocks, that they aren't just as capable as a lot of the major FANG stocks. This is a fantastic and well-run company that will continue to thrive no matter what the financial environment is out there. Now, banking is obviously not going anywhere, and in all honesty, you could probably throw Bank of America into this same category and you'd be doing just as well. But I had to pick one since I'm only allowed to pick 10 stocks for this challenge, so I decided to go with JP Morgan just because I actually use their products itself. I'm a little bit more familiar with them. I have the Amazon Chase credit card that I talked about earlier, and I've also heard a lot of people complain about Bank of America and all of the random fees that they kind of get. So that's kind of why I like JP Morgan just a little bit better than Bank of America. But again, I don't think that you're wrong if that's the company that you prefer. I think it's a totally fine purchase if you were to enter in this challenge yourself for the next 10 years. Now, with the way that I typically make my videos, what probably sticks out to you guys is I didn't really focus on the financials here very much. I actually barely talked about them. And the reason for that is when we're looking at companies to buy and hold over the next 10 years, while it's great to understand, some of the trailing financials and see where the company is going over the next couple of years, it's really the business and the moat that is the thing that's gonna make this company survive rather than a great financial position right now. So this is why I'm looking a little bit more into the story. Now, that doesn't mean that the financials aren't worth looking at if you're gonna make 10-year purchases. I just know that I've looked at all of these companies recently enough, and I know that they're all fantastic purchases at their current stock prices. But it's really hard to predict where these companies are going to be in the next 10 years because I just don't necessarily know exactly how much they're going to be earning. I can take a wild guess, but my confidence in that number is just not very high. So this is why I pay more attention to the story in these situations. While I might not be able to forecast what the company will earn in the next 10 years, I do feel very confident in knowing that these companies will be doing very well in the next 10 years. And that's the most important part about this. You need to understand the finances and the growth and not just buy any major mature company out there because some of those might not be growing very much. And if you're just investing in companies that don't really grow but they're technically safe, you might as well just buy bonds or the S&P 500 and not waste your time buying companies that are going to underperform. So those are my top 10 stocks that I would purchase for the $1 million challenge. These are all set it and forget it companies that I don't think you have much of a reason to be concerned about. But if you guys think that I missed one, please let me know in the comments. I would love to hear what you guys have to say. If you notice, I didn't include Tesla in there. And as always, thanks for watching.